how has the national property market performed over the last 12 months? And are we in this massive recession where property is crashing in price and it's all doom and gloom with higher interest rates? Or is there something more at hand here? So in today's video, we're going to go unpack that a little bit more. So make sure you stick around and let's go through that now. Guys, my name's Julian. I'm the head of strategy here at Ripehouse. And if you're new to the channel, here we talk about property investing and all strategies regarding property. If you haven't already, make sure you smash that like button and hit subscribe, because in today's video, we're going to be having a bit of a breakdown in terms of how the market's actually performed over the last 12 months. And we're going to do that state by state level, not only looking and breaking down its capital growth, but also its rental growth and maybe where those markets are heading over a period of time. Because obviously over the last 24 months, we've seen interest rates rise. We've hit a plateau for a period of time now. But if you're turning on the TV and watching the news at night, or you're logging into news.com, everything is about doom and gloom around interest rates. We're seeing we are seeing a lot of distressed sales and all these things. When you unpack the numbers, I think we're going to find that might be a little bit of a myth around that. So let's go into the numbers now. I'll put that on the screen. Okay, so what we've got here, we're using SQM's research data here. Want to avoid any, biases from our end. And we're looking at each state, a national average breakdown in terms of how it's performed from a capital growth perspective, and also how it's performed from a rental perspective. If there's any gaps there, and go into that more at a higher level now. So we'll start from maybe the bottom up, where we've got our capital city average, and we've seen there's been a bit of a dip over the last month, I should say, dropping about 1.8% rolling change. But nationally, over the last 12 months, we've actually gone forward in these capital cities 9.3%. Now, if you're unfamiliar in terms of long-term averages, and in this data sheet that we're going through here, we are just purely talking about houses. We don't want to compare inferior assets. So units, apartments, townhouses, duplex, whatever those you're thinking of, all we are talking about is houses for today's video. And we've gone through 9.3%. The national average over the last, say, 60 odd years is typically you see a 3 or 4 bedroom house double in value every 8.5 years. So around that kind of 7.3% mark. So we are significantly ahead of the national average. It might only seem like 2 percentage points, but 2% on a low number is a big jump. So we've seen that. And what we've seen also the rental pricing pretty much at a similar level. So capital city average has gone up about 9.2% on the national average. So from a difference where we've got a growth versus rent column here, there's a 0.1% difference. So we're pretty much hand in hand. And if we work our way through the national average, not too much of a discrepancy there, because obviously it's bringing in regional, and some of those regional centres have performed a little bit stronger than potentially the capital cities. They've seen 10% growth, which is phenomenal. And then if we go into the rental side of things, they actually haven't grown quite as strong as the capital cities, funnily enough. But there's been about a 1.4% difference. And then if we go up line by line, so where I'm sitting in the desk today, so we're down in Hobart, and that's a market that's just been holding steady for the last kind of 18, 24 months. It's actually been in a bit of a decline over that period of time, because it went through a big growth spike at the start of COVID, and the bit before then as well was a really affordable market. On the rental side of things, which is a really good sign for recovery, we're starting to see that rental market upswing. So initially, when the kind of everybody could get out and travel about, all the COVID restrictions were peeling back, we really saw Hobart suffer a little bit, because migration was kind of trending downwards back to Hobart. People are coming back, strong immigration coming, a lot of regional visas go through Hobart or Tasmania as a whole, and we're starting to see that rental growth. We're actually in the green we're plus 2.2% in terms of we had more rental growth than the house price growth, which is some early signs. If we're getting consolidation on the price point, or we're starting to see rental growth, some good early indicators there where some capital growth might be imminent, but it's not always just the number one factor. Then Darwin, again, there's kind of just pulled back a little bit, minus 1.7%. They're also going back on the rental side of things, so not a lot happening there. Funnily enough, Canberra, everybody's talking about Queensland and they're talking about WA when it comes, and Adelaide. Canberra's had a fantastic 12 months. Canberra has gone up 16.6% in terms of capital growth. But this is a bit of an outlier. We've actually gone backwards in terms of rental growth in that market as well. So Canberra is a market that we don't invest in. We don't invest in ACT here at Ripehouse because you're leasing the land there in ACT. But had some really strong growth. So more than double the long-term averages. So a strong year in Canberra. Then we're going to go into Adelaide. Adelaide has been the second strongest performer just under Perth. So they've got 18%, and they've had a couple of strong years at Adelaide as well. And they've seen double-digit growth as well on the rental side of things. But a bit of a trend line here. We've obviously talked Canberra having an outline, but if we have a look at Canberra, Adelaide, Perth, and Brisbane, where we've seen some really strong growth, though the rental markets in those areas, excluding Canberra, have seen some growth, they're being outpaced by the capital growth in those areas. So what that means is those areas that may have had 5% yields or 4% yields, they're starting to get compressed now. So they're going to get lower and lower, and you might start to see some investors cool their interest, because investors, when interest rates are a little bit higher, they're going to start to want to peel back. They may be worried about their cash flow side of things. So I feel like what's going to keep fueling that area there is going to be, we need to see either some rate cuts. We might need to see that rental market kind of keep pushing forward to keep investors engaged in those areas, because somewhere like Perth is the number one over the last 12 months, which is no surprise. It's gone for 22.9%. Now, understanding as well, if you're not familiar with the history of Perth, they had some real underperformance for a long period of time after going through that mining boom collapse. So when we're talking about kind of larger snapshot as an investor, we can't just get sucked in for looking at a 2 or 3 year window. Longer term, they're just above the average market. It pretty much goes Hobart, Adelaide, Perth and Brisbane now have definitely gone past Melbourne and Sydney. But it's not like Perth is so far ahead of all the other states in terms of longer term. But the last 12 months have been fantastic. And the rental market in Perth is still really, really strong in comparison. So one outlier here, there has been a bit of a difference in terms of there's a minus 9.4% swing versus the capital growth. But it was actually the number one growth state in terms of rental return. So just the market is just so hot over there. The rental market is still going, but it's just not going at the same pace. So going to keep investors engaged for a little while. The one thing you do need to be just cautious of in Perth is buying under market value. You need to be very careful. And if you speak to any Perth locals over there, they, particularly to the East Coast investors, they have a bit of a laugh at us, because I'm seeing a lot of, we'll call them East Coast investors who are potentially DIYers or maybe haven't been over to Perth. They, in my opinion, are paying overs for some very undesired locations. I'm seeing, and I won't name suburbs or pockets of Perth. I'm sure those following along would know them. But we're seeing some of those areas that, a couple of years ago, these places were $250,000, $300,000 you could buy a property in these locations. They are now upwards of $600,000, and Perth locals would, they'd be wrapping their cars in Kevlar just driving through. So just need to be very, very careful in Perth where you're buying and also what you're buying. What you don't want to be doing is, just because you want to get into a market, is be buying an inferior asset, getting yourself a unit or a townhouse or something just because you're so fixated on being in an area. There are always opportunities out there. You've just got to keep a look. Then we go into the Brisbane market. So that Brisbane market, again, a really strong year, 13.9%. So it's nearly doubled the national average over the last kind of 6 decades. And the rental growth has started to slow down in the Brisbane market. And I think what we're going to find in that Brisbane market as a whole, I think Brisbane is going to continue to be a really strong growth state in terms of longer terms. Infrastructure spend in Brisbane is very, very strong. But I do have concerns with Brisbane. There are a lot of projects coming through in terms of apartments, and developers are really trying to cash in on that market. I've seen it firsthand what it does here in Melbourne, and it does start to put a bit of a yield squeeze, because a lot of people just want a roof over their head at the end of the day, particularly if you're a renter or a investor. So it's going to start to cause a few issues on the rental side of things. But again, 6.3% rental growth, still a great return in terms of longer term averages. Then we get into Melbourne. Melbourne had a quiet month, and that's also been skewed by a poor month last month. So what we're seeing in Melbourne, particularly in Metro Melbourne, we're seeing a lot of people offload their properties that had investment properties there. So if you had $1 million or multi-million dollar property, you're now getting hit with land tax. Listings are still low, but where they were, say, 18, 24 months ago, there's a bit more stock coming through. So people have a bit more options to buy. They can be more picky and choosy with what type of properties they go through. But still, prior to last month, we're about 6.5% as growth. Had it one bad month there. So if we kind of zoom out, the average is about 6. So we're just slightly below the average, but something that's really promising to me in Melbourne, and I'm seeing it from a data perspective, particularly in your regional areas, is that rental pressure. So that rental pressure now, we've seen 10% growth, and it also had a fairly decent growth, and it's still trending upwards. And one thing to keep in mind with Melbourne, always had strong population. Builders are starting to really just continue to collapse more and more in Melbourne. So we're going to start to see more and more that construction squeeze. But in particular, there's still a lot of talk about reducing that immigration cap coming in because we've got a housing crisis. Regional Victoria will not be impacted because when we're getting these visas come through, in particular, they do get zoned to other areas, lots of universities and a lot of these locations as well in regional Victoria. So that's a really bullish indicator for me. We've still been tracking okay, some good buying opportunities potentially on the buying side from a capital growth perspective, but that rental pressure is starting to see these areas where maybe they were 4% yields. Now they're at 4.5. They might start to touch at 5 or early 5s. Really strong signs. And then we've got Sydney. So Sydney's had a pretty good, we're just an above average year. So 7.4%, rental price pressure 8.5%. So again, another one that's in the green. I'm anticipating that Sydney will still, Sydney always has those people who are rusted on to investing in Sydney, seeing some good strong indicators as well in some regional locations, coastal locations in the Sydney market. So that's a bit of a review. But I think what's really kind of eye-opening here is every single day there's a lot of negative news that comes out in regards to, interest rates, price pressure, mortgages, etc. The data is very, very strong here. So when you become a seasoned investor, really knows how to put the blinkers on and the earmuffs and ignore the distractions. It's the old Warren Buffett saying, when there's fear, that's when you should be buying. And when there's greed, that's when you should be selling. And for me, still really strong buying opportunities in this market. The best time to buy was yesterday. It's another saying that goes when it comes to property. So for me, the data doesn't care about all that hype. And we just want to make sure we stick to the numbers. So I hope you guys found today's video. Love to know your thoughts. Leave a comment in the box below. If you're not already, make sure you smash that like button and hit subscribe. And if you'd like to talk to me directly or someone on the team regarding property investing, or you're not really sure and trying to figure out your way through property investing and the research, go into the comment box, click the link. More than happy to pick up a phone call with you directly. So thanks for watching today, and I'll catch you guys in the next one. Bye for now.